When banks fail, governments step in. When governments fail, citizens pay. That's the pattern we've been taught to accept. But here's the mystery no one explains. If banks are supposed to take risks, why do they never absorb the losses? Why do financial institutions survive crises that destroy national budgets, collapse currencies, and erase decades of public wealth? Every crash follows the same script. Banks are rescued, debts are socialized, and nations emerge weaker than before. Tonight, we're uncovering the financial firewall, the invisible structure designed to protect banks at all costs, while pushing losses onto governments, taxpayers, and future generations. This isn't about corruption in one country. It's not about a single crisis. It's about a system engineered to transfer risk upward and losses downward. To understand the firewall, we have to rewind to a time when banks could fail fully and publicly. Before the 20th century, a failed bank meant bankruptcy. Depositors lost money. Owners were wiped out. Risk had consequences. But as governments grew larger and wars more expensive, a dangerous relationship formed. States needed financing. Banks needed protection. The solution was mutual dependency. Governments granted banks special licenses, monopoly privileges, and central bank backing. In return, banks funded wars, deficits, and expansion. This alliance quietly rewrote capitalism. Banks were no longer private actors alone. They became systemically important. And once something is declared systemic, it becomes untouchable. The first bricks of the financial firewall were laid with central banking. Central banks were sold as stabilizers, lenders of last resort. Their official mission was to prevent panic, but their real power was more subtle. They guaranteed liquidity only to banks. If a bank ran out of money, central banks would lend against collateral. If a government ran out of money, it would borrow, usually from the same banks. Already, the imbalance was clear. Banks had a safety net. Nations had obligations. As financial markets grew more complex, banks took on greater risks. Derivatives, leverage, securitization. Profit soared, but so did fragility. Instead of limiting risk, regulators did something else. They built cushions around banks. Deposit insurance calmed public fear. Bailout mechanisms were normalized. Central bank balance sheets expanded. Each reform had a comforting name. Each reform reduced accountability. Banks learned a powerful lesson. Risk was no longer existential. Losses could be passed on. Every system reveals itself under stress. The moment came during global financial crises, most famously in 2008. Banks had over-leveraged themselves. Mortgage securities collapsed. Balance sheets imploded. In a true market system, this would have meant mass bank failures. Instead, governments did something unprecedented. They absorbed the losses. Toxic assets were transferred to public balance sheets. Trillions were injected into financial institutions. National debt exploded over. Night banks were governments were weakened. And the firewall proved real. After the rescues, something strange happened. The crisis was labeled over. Markets recovered. Bank bonuses returned. Stock prices soared. But countries were left with massive sovereign debt. Austerity programs, cuts to healthcare, pensions, education losses had been converted from private to public. Citizens didn't vote for this. Parliaments barely debated it. Yet, generations would pay for it. This is how the firewall works. It transforms financial failure into national obligation. After each crisis, governments promise reform. New regulations, stress tests, capital requirements, but notice what never changes. Banks remain too big to fail. Central banks remain backstops. Public debt remains the Reforms are designed to stabilize the system, not to challenge its hierarchy. Because dismantling the firewall would mean allowing banks to fail. And that would expose something terrifying. The system depends on constant rescue. Look at recent years. Pandemic-era bailouts, emergency liquidity facilities, central banks buying government bonds once again. Losses were absorbed upward. Private balance sheets healed faster than public ones. Corporate debt was refinanced. Asset prices inflated. Governments inherited the bill. Debt didn't disappear, it changed owners. Here's the structural truth. Banks create credit. Governments guarantee it. When credit collapses, guarantees activate. The firewall exists because banks operate globally, governments operate nationally, capital can move. Debt cannot. So when things break, responsibility falls on whoever cannot escape. That's the nation state. Over time, repeated bailouts erode sovereignty. Governments become more indebted, more dependent on central banks, less able to resist financial pressure, policy space shrinks, choices narrow. Citizens feel it as stagnation. What looks like financial stability is actually slow erosion. First, banks are shielded by design, not by accident. Second, crises don't destroy debt. Relocate it. Third, the firewall protects capital, not countries. Every firewall has a limit. As debts pile up and trust thins, the question isn't if pressure builds but where it breaks. What happens when nations can no longer absorb losses? And when that moment comes, who will be left to rescue the rescuer? If this changed how you see financial crises, subscribe to Credit Clever. We don't explain symptoms. We expose structures. Like the video, share it with someone who still believes bailouts protect the public, and comment below. Who do you think the system is really designed to save? Because the most dangerous walls are the ones you can't see.